We are live on Facebook as well. Hello, everyone. Thank you for joining us on the Start Omaha Work Week. Today we are featuring Ben Williamson. And Ben is going to talk to us today. Ben's from Invest Nebraska. And I lost my thing. There it is. Okay. And Ben's going to talk to us today about funding for innovation and entrepreneurship in Nebraska. All questions need to be asked either through the Q&A feature or the chat. Microphone is not available. If you have a comment, go ahead and leave that in chat, but we do ask that you be respectful. And if you'd like to watch this program again, we will be recording it and putting it on our Do Space YouTube page later next week. And as a general reminder, after each program, make sure you head over to Beanstack, and I will drop a link for Beanstack in our chat here in a second. That's our community engagement platform. There you can mark that you attended the webinars throughout the week, and you can enter to win some really awesome prizes. We have 3 gift cards to give away to local small businesses, and then a headshot session. So I'm going to drop Beanstack. I'm going to actually drop all of these helpful URLs in our chat channel right quick. As an attendees. And if you are joining us from Facebook, there is still time to join us in Zoom and be able to ask questions. Ben, as soon as we hit 1 o'clock, I'm just going to hand it over to you and let you go.
Sounds great. Thank you so much for the introduction. Looks like we're right at 1. So if others trickle in, that's fantastic. As was mentioned in the introduction here, just wanted to chat about funding, innovation, and entrepreneurship, specifically in the state of Nebraska, but even more broadly than that. The reason, and I think this was in the description, but the reason I think this is an important discussion is historically, there was this kind of opacity, this black box mentality around funding for startup companies. And when I say startup company, I guess I should be clear. I mean all small business. That doesn't mean only tech startups, really all startups, but there's always been, it's always been hard to kind of understand what type of funding makes sense for my company. How do you raise money? And it was always sort of on purpose, I think, to make it a little bit more exclusive. And within the last couple of years, we're really moving into this environment of transparency and accessibility for people. And so as part of that, I think it's important just to be able to talk about funding, specifically for innovation and entrepreneurship, especially within our local ecosystem. First, I guess, before I get started, maybe I should answer the question, why do we care about funding for innovation and entrepreneurship? And I think the main reason is that it has been, they've done studies around this. When I say they, in this case, I'm referring to the Kauffman Foundation, which is a several $billion-dollar foundation based down in Kansas City. Many people listening may be familiar with it. Did some studies around economic development and net new job creation, and not just in the Midwest, but more broadly in the United States. And what they found is that all net new job creation, virtually all, that means like 90%, come from small businesses and startup companies. What does that really mean? I think what it means is if I'm going to create a new service type business, or I'm going to create the next BMW plant in somewhere in rural Nebraska, which, by the way, that's a completely valid pursuit. But what they would argue is that you're not actually creating net new jobs. You're merely transferring jobs from one place to another. And the only true way to create those net new jobs is by small business and startups. And so I think that's the ultimate reason of why we should care. Just another quick introductory comment. My goal is for this to be very it's hard to make this conversational because of just the Zoom presenter formats and things like that. But I want to make this as conversational as we can. So please ask questions. I will try to keep an eye out as they come in and stop if necessary. but my goal is to not go the entire length here. And I apologize. I got to figure out how to. Okay. So first, I want to give a little bit of background on Invest Nebraska. For those that don't know, Invest Nebraska is, for all intents and purposes, a state-funded venture capital organization that also tries to accomplish some broader level of economic development in the state of Nebraska specifically. So ultimately, we partner with the state of Nebraska, receive money from the state, and turn around and invest that into Nebraska innovative technology companies. As part of that, we also try to focus a lot on education and building infrastructure in the state of Nebraska. Education could be everything from conversations one-on-one with entrepreneurs to events like this. Or actually, I'm currently sitting at a Scooters in Ogallala, Nebraska. I'm traveling out west with a colleague to have conversations around innovation in the state. And so that's one piece of the one leg of the stool, if you will, is this education piece. The second that I talk about is infrastructure building. That could mean 100 things, but when we say it, I think we mean helping support the infrastructure that's in the state of Nebraska and helping create new infrastructure to the extent necessary. So DoSpace is a fabulous example of a piece of infrastructure in the state of Nebraska available for entrepreneurs, small business owners, or others in the community. There's some accelerators and incubators that I'll talk about later in the presentation that are pieces of infrastructure. There are tools that the universities in the state have at their disposal that are pieces of infrastructure. Really anything that supports entrepreneurship, I consider to be infrastructure. And so we try to commit to building and helping facilitate those pieces in the ecosystem. And then the third leg is the obvious one. That's the investing side. And that's what I have listed here. We invest $125,000 to $250,000 each check into 15 to 18 investments a year. And we are industry agnostic. We invest in everything from technology, software businesses, to medical device, to tech-enabled service businesses, to ag tech, to fintech, to insurance, to education, to consumer. We will literally do any type of investment as long as it's innovative and technology driven. And we'll get into why that is a little bit later. We enjoy leading deals. That just means we work with the entrepreneur to set the terms of the deal. But we also will follow along with other investors as well, which is important as we try to bring money in from outside the state of Nebraska into Nebraska companies. And we also have various financing options available, and we'll get more into what that means, but primarily equity versus debt financing. And below there, that very last line, it's important. In fact, it's legally required of us that we always invest alongside other angel investors or other venture capital firms or corporate groups. Like Nelnet is an example in Nebraska that does a really fabulous job investing in startups. The Nebraska Angels is another group as well that we'll talk more about later. So that's a little bit of the background. I've been with the organization about 3.5 years, a little over that, and previously was an in-house attorney prior to that. So I guess it's important maybe to take a quick step back and say, first of all, what is venture capital? What is angel investment? I think most people understand this, and especially in today's day and age where Twitter is front and center in a lot of these conversations. Everyone sees these companies that raise hundreds of millions of dollars. And so I think people are generally aware, but just to take a step back and go through that piece of it, it at its most simplest level is financial capital provided to early stage, here's the important part, high potential, high growth, and high risk startup companies. And we'll talk more about this, but these are typically companies that are unable to raise traditional financing like bank debt, excuse me. The next part's also really important. So I mentioned these are high risk companies and high risk investments. So in exchange for that high risk, investors typically ask for and receive a little bit of control in the business and protection in the business. And the main reason for that is, as an investor, I do not want to have day-to-day control or access in your company. I don't want to come in and act like I know how to build companies, because I don't. I don't know anything more than anyone else. But because I don't have transparency and insight and access to the day-to-day workings of a company, there are certain protective provisions. Like, for example, a good example is a board of directors. Oftentimes when companies raise money, they will be required to set up a board of directors that helps that entrepreneur manage the company. And that is an example of one of the protective provisions that an investor might ask for and get. Obviously, the last piece there, getting ownership in the company, is obviously what you're getting in exchange for the risk as well, and hoping to share in the upside of that company. So another big question, sort of an existential question in this conversation, is when we go and if you're any sort of company, again, this can be a tech startup, this can be a regular sort of service, traditional business, a Main Street type business, what are our goals and our outcomes in raising money? So oftentimes we will get companies that come to us and say, I want to raise X amount of capital. And then when we sort of dig into that, oftentimes the entrepreneur will come to the realization that they just wanted to raise money because they think that's oftentimes what you ought to do, and that's what everyone else does. But it's really important to take a step back as an entrepreneur and as an investor and think about what are our desired outcomes here? What is our goal in raising money? And before I go into these, I think it's important to note that your investor and you as an entrepreneur need to be 100% aligned with your desired outcomes and your goals. The second you become misaligned, that's when companies fail, honestly. So what are potential goals and desired outcomes? So I just listed a few examples here that we hear all the time. So one that you hear in sort of the venture capital, high growth space is, I want to grow fast, build a big company, and sell it within the next 5 to 10 years. Obviously, that's kind of, again, that's romanticized in today's tech day and age. The second one is probably equally important, but also equally prevalent in the ecosystem. I'm working on a business that I'm passionate about. I want to grow it organically so that I always maintain control. And this also ties in with the next one, but I don't have to sell it if I don't want to. And then the third, again, just sort of an extension of that second one, I want to run this business forever. I want to maintain control. I want this to produce wealth for me and my family, hopefully for as long as I can see forward. And then another really common goal or outcome is, I don't know. I've thought about this. I'm not sure. And that's a totally valid thought as well. But it's important to know that you don't know, because that changes our decision making when we go out to raise money. It changes that opportunity cost calculation that we'll talk more about it. And I just mentioned the last thing and the most important thing to understand here is, and I think this is obvious to everybody, but it's worth reiterating. Each of those options above, they're all different. They all have a separate opportunity cost. So when you choose one of those, it sort of rules out other options, and it sort of takes you down one path instead of another path. And so that's the next couple slides are sort of based around that thought process. So moving forward, I guess, what are financial options for companies? So I am going to say we're going to break this down generally into 3 buckets. I should have done 3 columns instead of 2. That's confusing, but 3 buckets. So the first is what people often call bootstrapping. Bootstrapping literally just means figuring out ways to grow your business really without raising money specifically for the business. So that can be things listed here like grants, state grants, federal grants. We'll talk about some of those available to Nebraska companies in a bit. That could be going through an incubator or an accelerator or winning money at a pitch competition. Those are all forms of bootstrapping. It could be going to your parents or grandma or your aunt and uncle or your friend's parents to get some investment dollars, often known as friends and family capital, or for the more realistic of the group, friends, family, and fools. Maybe you've heard it called that as well. Nights and weekends. So what I mean by that is you keep your day job, keep your sustainable, secure job, and work on a side project nights and weekends. Oftentimes that extends your runway to allow you to build a company or a startup or a side hustle without having to take on capital. And the last that I've listed there that has become more popular since probably 2012 timeframe with the Jobs Act and some of the changes made within crowdfunding, Kickstarter, Indiegogo, Patreon, and there's others, as we know, emerging all the time for different types of creators. That is the first bucket. I think that's where everybody should start. Everyone should come at this, and Nebraska entrepreneurs are actually really good at this. Start from a bootstrap mentality. Build your business with that in mind. And then when you get to a certain point where it makes sense to potentially bring in outside capital, you can make that decision. But I think it's important to come at a business from a bootstrapped mentality. The second bucket is equity investing. So that is basically the first two bullets on that second column, venture capital or angel investment. Also, I guess you might say, well, friends and family capital could be equity capital, which is true. But I view that sort of as a form of bootstrapping. So let's just focus on venture capital, angel investment. That's exactly what we talked about on the previous slide. I give you money in exchange for some ownership of your company, and I get some protections and a little bit of control to protect my investment. The third bucket is what I would consider traditional financing. That is, in most cases, bank loans, lines of credit, or other organizations that lend money as well. I would put in this traditional financing bucket. Now, it's obvious, and we can talk more about this, that there are types of companies that fit more perfectly, I guess, in two different buckets over others. So, for example, there are many businesses that are able to raise debt financing, but as many of us listening to this know, oftentimes banks require years of financials. It's hard as a startup or a small business to go get bank debt. And that's completely valid, but that's because banks are in the no risk business, not the low risk business, and certainly not the high risk business. And we said at the outset that technology and innovative startups are in the high risk business. Now, on the sort of other hand, you have these higher growth companies where they don't have financials. Maybe it's just an idea on the back of a napkin. Maybe there's a prototype that's out in the market, but they want to grow fast and sell their company. Obviously, bank debt wouldn't be appropriate in that case. And so they look to the more equity-based pieces of financing. So those are the three buckets, the three primary buckets. Now, worth noting that there are sort of hybrids between the models that have emerged in the last couple of years that are completely valid, but it's easier mentally to just separate that into the three buckets. Now, this slide, I apologize, is a terrible graphic in terms of the quality, but I leave it in here because it's super important. And it is a graphic of the opportunity costs of capital. I said this at the outset, when you make a decision about what type of capital you want to raise or don't raise, you see bootstrapping is in this graphic as well. There's an opportunity cost to each. In other words, you're giving up some other option by choosing that. And so I won't go through all of these, but I will sort of generally go through it because I think it's important, and this is really helpful for entrepreneurs as they start their journey and decide how to grow their business. So the first category, again, bootstrapping, that can be any number of things, but the takeaway is it gives you high flexibility operationally, meaning you can operate your business however you see fit. No one else is telling you how to operate your business. No one else has any control or protection. The universe of outcomes that's acceptable to you is also very high. In other words, it's only up to you. So you get to decide what type of outcome, sale, running your business forever, spinning off cash, XYZ is acceptable because you're the only owner. And lastly, liquidity is also high. Again, you can pay yourself a salary, you can spin off profits in the form of distributions, or you can also invest your own money as well. So there's a high degree of liquidity. Now, the next two, as mentioned, are both sort of in the equity bucket, but they are a little bit different. And that is because in angel investing, you're dealing with an individual that maybe has their own, they're viewed as being a little bit more easygoing and not as rigid. And I can talk about why in a second. In that case, operational flexibility is also pretty high. Occasionally, you might find an angel investor that wants to come in and help build the business. It depends on your partner, but generally speaking, you have a lot of control and flexibility on your own business there. Again, the universe of outcomes is also high. This is a little bit of an asterisk next to this one because most angel investors do expect you to try to sell your company, but they are a little bit more passive and a little bit more patient, perhaps, than venture capitalists might be. Again, we'll explain why with respect to how venture capital funds are structured. Lastly, liquidity. Obviously not quite as liquid as if you just bootstrapped your business, because now you have other mouths to feed, so to speak. The third category then is venture capital. And of course, you see the benefits of all these as well. But now you all of a sudden have low operational flexibility because you've taken capital from somebody that has requirements of their own. And I'll go super briefly into the structure of a VC firm. Typically what they do is they raise a fund. It could be $1 million, could be $100 million, could be billions of dollars. And they raise that money from limited partners or investors. And what they promise those investors is, I will return your capital and hopefully money on top of your capital within the next 10 years. And so what that means then to the venture capital firm or fund is when they invest in your company, they have a clock now that they have promised their investors. And so they're going to encourage and incentivize you to also follow that timeline. Again, going back to one of the very first things I said, you need to make sure you are aligned with your investors. So you should never be in a situation where you want to run your business forever and you take venture capital. Those are in inherent misalignment. The universe of outcomes is also low. And this is, again, because of the promise venture capital funds and firms are promising their investors, which is, we think we can beat the stock market. And because of the math on investing in venture capital, because these are high risk businesses, there's going to be a certain percentage of those that fail. And so to make up for the failures, we have to have some that outperform others. And that could be a 5 times return, a 10 times return. You could find the Uber that's over 100 times return. But in terms of universe of outcomes, if I'm a venture capital firm, I don't just want my money back. I want some multiple of my money because I've packaged this fund to sell to other investors. Again, totally valid. You just need to make sure you're aligned with your investors. And lastly, the liquidity, also low because the universe of outcomes has shrunk. I want you to get acquired. You could go public through an IPO, or another bigger investor could come in later and buy you out. But those are really the only options. Whereas just to contrast it to the angel, maybe the angel is okay with you paying them distributions until they get their money back. Typically, a venture capital fund or firm would not be okay with that. That would not be one of the accepted universe of outcomes. Last two I'll go through relatively quickly. Bank debt, I think it's more obvious. It's kind of a medium option. Doesn't dilute your company. It gives you some operational flexibility, but banks will put covenants in debt, and covenants are agreements that go forward and say you can and can't do certain things, like take on additional bank debt. Maybe there's a covenant against salaries going over a certain point, a covenant against getting liens on any of your assets, your property, because you've already promised those as collateral to the bank. So it's medium operational flexibility. The universe of outcomes, also sort of medium. You have to pay the bank back. That's why it's not low, because you have to make sure that happens. And then liquidity is, of course, high. The bank doesn't care how they get their money as long as it's repaid. The last category is what I sort of mentioned as one of these hybrid categories between sort of debt and equity. It's become popular in recent years, called revenue-based financing, RBF for short up there. Basically, just really quick, that is when an investor will give you money and say, you pay me back a percentage of your revenue, let's say 5% of your top line revenue, until I reach 2x or 3x my investment. So if I lend you $100,000 and say, pay me 5% until I get 300,000 back, it's sort of more expensive than debt, but cheaper than equity in the long term. So again, in that case, you have sort of medium operational flexibility, medium universe of outcomes, and high liquidity. It's similar to the bank in that regard. Again, this is not an exhaustive list of all the types of capital, but it does a good job kind of giving an example of the opportunity cost calculation that entrepreneurs and investors have to make. So I promised that we would also talk a little bit about what investors look for. And honestly, I want to put this in the perspective of an entrepreneur first. And that is, yes, investors also care about these four things, but as an entrepreneur, you should also care about these four things, regardless of if you raise money or not. When you're deciding whether to start a business, these four questions ought to be central to that decision-making process. So one is, first and foremost, this is the most important thing. Does my solution solve a compelling problem? You could even make that simpler by saying, have I found a compelling problem to solve? You might not even know what your solution is yet, but have you found a compelling problem? That is the single most important calculation when starting any business. So I'm a huge fan of the show Shark Tank, but I think one of the downsides of Shark Tank is it has, I think, put this vision in entrepreneurs' heads or the general public's heads that says, I have to think of a $1 million solution or $1 million idea, which is actually backwards. You need to find $1 million problem and then figure out how to solve that. So that's number one. Number two, does the business model work? And that is as simple as, when I sell one unit, do I make money on that unit? If the answer is no, the business model probably doesn't work. Now, of course, there are exceptions to this, the most famous of which is like Facebook or some of those bigger platforms that don't monetize for years. But at its most basic level, this is a central question to starting even a software business. I need to make money on each incremental unit. Otherwise, it's going to be really tough to scale with or without outside capital. The third is, how big can it be? I want to stress that the answer doesn't matter. I don't care if the answer is small, medium, or large, but you need to know as an entrepreneur, as a small business owner, what is my plan to scale? How big do I want this to be? How big can it be? And then the last and one of the most important is, what is your differentiator? Why me? Why now? And the reason this question is important is, in 2021, it is safe to say that 99.99999% of ideas in the world have been tried or are being tried. Sure, there's when new technology moves the progress needle forward, opportunities emerge. But it's safe to assume that somebody is doing what you're thinking of doing, or has tried to do what you're trying to do. And so the question you need to ask yourself is, what do I know that they didn't know? Why am I going to succeed when they failed? And then why now is sort of a logical extension to that question. Was the market opportunity not ready a year ago, but now because of ABC, the market is ready. So now is a better time. And that is one of my differentiators. So those are the four central considerations. Yes, they're the central considerations for raising money, but they also are the central considerations when you start a business, in my opinion. So I'll go through this more quickly because we'd love to get to some questions, but what are additional considerations to raising capital? And some of these will look familiar from the last slide. That is intentional. The first one, I had to reiterate this one. Is there a customer? Do you know who that customer is? Specific customer? Do they have a compelling problem? And this is important. Are they motivated to find a solution to that problem? It is really hard to build a business around a problem that the customer doesn't know they have, or that isn't urgent. So everyone's probably heard the analogy, you want to invest in painkillers, not vitamins. Because vitamins, people know they should take a vitamin, but it's not an urgent thing. But if you're in pain, that's urgent. So that's exactly what that expression is referring to, that first consideration there. Second, is my solution the right solution to solve that problem? Oftentimes people find a valid problem, but then develop a solution that maybe doesn't tie back or fix that problem. Now this is getting more into the venture capital side of the world rather than traditional financing, but is it a really big market? Of course, that is important when you're building sort of a high growth, high scale company. And again, worth noting, I think I've alluded to this, but like, it is completely valid to build a business that isn't in a huge market. But in the sort of venture capital space, this is an important consideration. Number 4 applies across the board. Is there room in the market for a new player? Is it saturated geographically, or is it saturated in a way that's going to be hard to differentiate myself? Is there room in the market? 5, I think this is applicable across the board as well. We talked about the business model, the unit economics on the last slide. Now we're asking a second question, does it scale? So when I do add incremental units or 100 or 1,000 new customers or incremental units, does the pricing still work or does it fall apart? Number 6, I think this applies across the board. This is referring back to the last slide as well with differentiation. Is my solution defensible? Is there a moat that I can build around myself? That could be intellectual property. That could be some other competitive advantage that I think that I have, that someone from the outside, when they see my success, you're going to have people try to copy you. What is my defensibility around my idea, my solution, my team, any of those things? Number 7 is an exact extrapolation of that. Why me? Why now? Why us? I think that's super important. And then last, and I don't know if this should have been last or not, but is there a compelling cross-functional team in place to build this? I think everybody, when thinking about early stage investing, has heard the expression that you bet on the team or bet on the jockey, not the horse. That's a big part of investing in early companies, because you don't know necessarily if the solution works very well. You don't know how it scales, but you do know the team that's in place to build it. And sometimes that's enough to invest in. And so as a founder, I need to ask myself, do I have people that complement my skill sets and that can help build this company? Again, I think you need to think about that regardless of whether you are going to raise outside capital or not. I think it's super important and central to that go or no go decision. So I mentioned this at the outset, but I thought it would make sense to list some of the options that are out there available to bootstrap. So you have a category, accelerators and incubators. I think people are generally familiar with those, but really just refer to infrastructure to help startups, entrepreneurs, small business move forward. So sometimes there's money involved, sometimes it's mentorship, sometimes it's just subsidized office space. In fact, I probably should have or could have included DoSpace as a sort of pseudo incubator, but those are just some of the options in Nebraska. InMotion, powered by Generators in Lincoln. The Startup Collaborative is in Omaha. The Combine and the Biotech Connector are both on Nebraska Innovation Campus, but they are run by Invest Nebraska in partnership with the university and the state. But Combine is ag tech, agriculture technology, and the Biotech Connector is obviously for biotech companies. So there's a lot of options. Those are just local. The beautiful thing about 2021 in the post-pandemic world is now, of course, on this Zoom call here, we all know this, but we all have realized that we can do things remotely and do them nearly as well as we could have in person. And so that opens up these options for startups and entrepreneurs to do accelerators and incubators all over the country that we might not have otherwise had easy access to do. The middle category is probably the most important: grants. The state of Nebraska has a bunch of grants available that most people don't actually know about, or at least not enough people know about. For example, there's a prototype grant where if I'm building a software solution or a hardware solution or a medical device or anything, I can go get a grant from the state to build that prototype and get it out into the market. There's also a grant if I want to do research and development with a university or a professor or a PhD or a postdoc. I can get a grant to do that research. And lastly, there's an SBIR matching grant, which is directly tied to the next one down. The US Small Business Administration at the federal level gives out grants from their sub-agencies. So think USDA, National Science Foundation, National Institute of Health. All of those agencies give out grants. And if a Nebraska company gets one of those grants, the state automatically matches it up to a certain percentage or dollar amount to just incentivize those companies to stay in the state of Nebraska. And so those are actually, I guess, the next two categories there. The state also has other grants, depending on what type of industry you're in and where your company's located. Those are the primary ones that are focused on technology and innovation. Lastly, there are tons of pitch competitions all of the time. I listed two of them here that are maybe more familiar. Inside Outside Summit, which has historically been hosted in Lincoln, always has a grant attached to it. There was a Get Started Omaha pitch competition that was going to happen, I think, in April of last year or May of last year, that obviously got postponed. And in fact, they ended up combining with Inside Outside Summit for the grant. There are tons of other examples. I talked to some farmers a couple of weeks ago that they have a beef alliance, and they're doing a reverse pitch competition to get people to help solve problems in their industry. That's in Nebraska. There are tons that people don't know about, that just networking and asking the right questions you can find out about. Obviously, those really help you bootstrap. I think this is probably the last slide, but just on the venture capital side, what are the options available in Nebraska? And I did not include the Midwest more broadly, but there are tons of options in the Midwest. Obviously, Invest Nebraska is the one I'm partial to, but we partner with every group on this page. I mentioned the Nebraska Angels. That's a group comprised of accredited investors, individuals, based primarily in Lincoln and Omaha, but there are some members that are elsewhere. And companies come and pitch. 2 companies a month typically come pitch to a group of angel investors. I mentioned Nelnet earlier as sort of the gold standard when it comes to corporate innovation and corporate venture capital. A newer entrant into the market, Burlington Capital, has recently launched 2 new early stage venture capital funds, one specifically focused in ag tech and one that's more agnostic. They are a newer entrant into the market. Dundee Venture Capital is based in Omaha. Many are familiar with Dundee. And then 2 that are really important are, there are 2 student-run venture funds connected to the university. One has been around for 4 or 5 years, the Maverick Venture Fund at UNO, where they will invest in startup companies and ideas that are somehow connected to the University of Nebraska. And then the Husker Venture Fund, which is being launched as we speak at the University of Nebraska-Lincoln, which will do the same thing for technologies connected to the University of Nebraska broadly as well. They're a little bit smaller checks, but they could help companies kind of get to that prototype stage, or really get to the point where they can scale their idea in their business. That's last page. That's my contact info. Open lines of communication for everybody. Would love to talk as a follow-up with anyone that has questions on Nebraska, the ecosystem, innovation and technology, venture capital, or any of the above. So want to be accessible to everybody, and would love to answer follow-up questions as well. So that was, I talked way too much, but we still have, I think, about 20 minutes for questions to the extent we have any. So I will pull that. So it looks like in the chat so far, just have the initial announcements, which is just fine. Feel free to, anyone, feel free to place questions in the chat. Otherwise, like I said, feel free to follow up as well, and happy have a follow-up conversation. So thanks for your time, everybody.
I noticed a few people have their hands raised. We
Got it.
aren't unmuting mics. So those
Okay.
folks that have their hands raised, if you have questions and can go ahead and either put them in the chat or use the Q&A feature, we can get those questions answered for you. Martine says they would love to get a copy of the slide deck. Ben, is that possible that we could get that?
Absolutely. I will send it as a follow-up, and then you can distribute however is easiest.
Perfect. So Ben will send it to us here at DoSpace, and then those of you who are interested in getting a copy of the slide deck, if you would send an email to programs@dospace.org, and I'll go ahead and put that in the chat right quick. Programs@dospace.org. Shoot us an email there, and we will get you a copy of the slide deck. Does anybody else have any questions? Give it a few minutes here to see. I'm not seeing any questions right now, but certainly if you have questions later, feel free to reach out to Ben or reach out to us and we can get you in touch with Ben. Ben, thank you so much for coming and speaking with us today. Any final thoughts before we head out?
I don't think so. Just again, to reiterate, please follow up with questions. Would love to chat with anyone and everyone. Trying to make this topic more accessible to everybody across the state. And we haven't always done a great job of that. So would love to even just talk shop and talk entrepreneurship and talk ideas. Would love that. And thanks for having me. It was a blast. Sorry for just talking at you for 40 minutes, but I would love to chat.
Awesome. All right. Well, folks, if you are interested in other programs like that, we are running programs such as this all week. Head on over to our calendar and definitely sign up for more things. We've got plenty on the agenda for this week. And take a second to log into Beanstack again and mark that you've attended. And we will be drawing for prizes later in the week for some great small businesses here in Omaha. And if there are no other questions, I think we're going to go ahead and sign off for today.
Thanks, guys.
Yes. Everybody have a good day.